In our previous video, we explored how debits and credits are used to capture and communicate the flow of a company's economic activities. We demonstrated the relationship between debits and credits, explaining how they work together to represent the details of a transaction or event. By debiting and crediting specific accounts, a business adjusts the balances of these accounts to accurately reflect what occurred. This process is known as recording an entry, which recognizes the transaction or event in the company's general journal. So, what exactly is a general journal? Imagine a general journal as a personal diary where someone writes about what happened to them each day. Similarly, a company uses its general journal to record entries representing transactions and events on the dates they occur. These entries, organized chronologically, are essential for maintaining an accurate record of business activities. Debits and credits within these entries determine how account balances are adjusted to reflect the impact of each transaction. Let's now move on to recording the first of 10 business transactions for ABC's clothing company. These transactions were analyzed using the accounting equation in our previous videos and will now be recorded in the company's general journal. Transaction 1. Bob, the owner of ABC Clothing Company, contributed cash of $20,000 and t-shirts valued at $10,000 to the business. Let's assume that this transaction occurred on January 2nd. To begin, we'll need to set up the general journal. This setup includes the following components: the transaction number, the transaction date, the account description, a debit column, and a credit column. Here's how the general journal is structured. Next, we'll record the first transaction in the company's general journal, starting with the accounts that need to be debited. The accounts to be debited are cash for $20,000 and inventory for $10,000. Both are asset accounts, representing the business receiving $20,000 in cash and inventory, t-shirts, valued at $10,000. Debiting these asset accounts increases their balances, reflecting the addition of these resources to the company. Here's the first part of the journal entry, showing the accounts being debited. The last part is to account for the source of the resources. Who or what is funding the cash and inventory contributed to the business? In this case, Bob, the owner, is providing the total contribution of $30,000. Since Bob contributed $20,000 in cash and $10,000 in inventory, the owner capital account will be credited for the total amount of $30,000. Crediting this account reflects the owner's investment in the business. Here's the second part of the journal entry, showing the credited account. Note that the account description is indented to distinguish it from the debited accounts. As explained in the previous video on debits and credits, a debit represents the receiver, while a credit represents the giver. In this transaction, the owner, the giver, contributed cash and inventory to ABC Clothing Company, the receiver, clearly demonstrating the cause and effect relationship of this transaction. Before proceeding to the next transaction, we need to confirm that the total of the debit column, $30,000, equals the total of the credit column, $30,000. In this case, the totals match, ensuring the entry is balanced. In the next video, we'll continue recording additional business transactions in the company's general journal.